In today's video, we're going to talk about Medicare in retirement, how it works, and why it is that some retirees pay hundreds of dollars extra per month, even up to an extra $1,000 per month for the exact same Medicare coverage as other retirees. Then I'll go over some practical tips and planning strategies that you can consider to improve your overall retirement situation and avoid these extra Medicare costs. So let's get right into this video. Medicare is the health insurance program for retirees in the U.S. over age 65. Now, if you're over age 65, you don't technically have to be on Medicare. The number one exception to this is if you're still working and covered by a health insurance plan with your employer, then there's no need to sign up for Medicare. Now, if you're not employed, you also don't have to sign up for Medicare, but once you do, there are permanent penalties that will remain in place for you for every single year that you did not sign up when you were supposed to. Well, what I want to focus on today is the cost that everybody has to pay for Medicare, which is your Medicare Part B premium. Now, if you've already applied for Social Security benefits, then this premium is deducted directly out of your Social Security check, so you don't even see it. If you're over 65 and you've not applied for Social Security, you have to pay this premium directly, basically send money every quarter to the Social Security Administration to pay for that premium. The amount you pay for this premium is actually not the same for everybody. The amount you pay for the premium is based off of your modified adjusted gross income. Very simply put, the more money that you earn in retirement, the higher you'll have to pay for that Medicare Part B. If you make less, you'll pay less. Now, those income limits are different, again, whether you are a married filing jointly retiree or if you are a single retiree. So it kind of has some parallels to other elements of the tax code that are, there's differences based off of married filing jointly or if you're single. So what I want to look at is just how much of a difference these Medicare Part B premiums are, what are the income thresholds, and then, like I said in the intro, just what are some of the planning strategies you can use to kind of avoid having to pay higher amounts. So first thing I'm going to do is let's pull up a chart on the screen and look at what are those income brackets for Medicare, and we'll go from there. All right, so here on the screen in front of us, we're looking at a little table here that goes over your Medicare, the Medicare Part B premium costs. So there's a base premium that everybody pays for Medicare, and for 2025, that is $185 per month. Along with Social Security, every single year, the Medicare Part B premium gets adjusted. So you'll notice that, once you're in retirement or, whenever, that they'll announce what is the increase for that premium, for the upcoming year. Okay, so everybody pays $185. Now, below, let's look at this table. So that premium is going to vary based off of your income, but it's kind of a little complicated calculation for income. So it's not your taxable income, which is what applies to your federal tax bracket rates. It's actually your modified adjusted gross income. And so I've got other videos where I kind of break that down further, but it's based off your modified adjusted gross income, and it's based off of that income from 2 years before. So for example, if you retire when you are 64 and then you're 65, you get onto Medicare, they're actually going to look at what was your income when you were 63. So this is one of the situations where somebody who, if you've earned a lot pre-retirement and then you transition to retirement and your income is going to be lower, then you can find yourself in your first year of retirement paying a higher Medicare Part B premium. Now, I should say that this 2-year look back for income, it's a rolling 2-year look back. So, if when you were 63, you had a really high income, which forces you to pay a higher premium, then the next year, let's say, when you were 64, you had a lower income, then your Medicare when you're 66 will roll off and drop down and be lower going forward. So there's that 2-year rolling look back on your income. So let's look at the different brackets. So first here in this first column, we have married filing jointly. So as you can see here, if you earn less than, if your MAGI is less than $212,000 per year, you're just going to pay the base $185 per month per person in your household for your Medicare Part B. Then the next bracket, if you're between $212 and $266, you have to pay an extra $74 per month per person. And it just continues up from there. You can see between $266 and $334,000, you pay $185 extra per month, then an extra $300 per month, an extra $400 per month per person. And finally, if you're in a very high income level in retirement, $750,000, then you pay an extra $443 per month per person. So I don't run into many retirees with a regular annual income in these higher levels, but this can hit you, let's say if you own a rental property and you happen to sell a property in a given year, or you have some large gains in your brokerage account, you sell some investments, and you could find yourself jumping up into these higher brackets. And at least for 2 years in the future, you'll end up paying higher Medicare Part B premiums for that year. Okay, so you can see that these brackets are pretty large. I mean, you don't have to pay anything extra until you have at least $212,000. But now let's look at what's the case if you are single in retirement. You can see now that you can only have up to $106,000 of income before you jump up to the next bracket. Then, as you can see, these brackets up to between 106 and 133, you're paying that extra $74 a month, and so forth, following this chart down. So there's quite a big discrepancy between married filing jointly and a single filer as far as how much income you can have in retirement and still just pay the base amount. Where I see this being an issue for most retirees is when they have most of their savings in pre-tax retirement accounts like 401ks or IRAs, and once they get later on retirement and they don't need the income, but they're forced to take it through required minimum distributions or RMDs, and that's where they can be pushed inadvertently into these higher brackets and not only have to pay income tax on that money, but also have to pay higher Medicare Part B premiums. Now, I should say this video isn't about Social Security per se, but having your income go higher, it also subjects you to paying more taxes on your Social Security benefits as well. So through the provisional income rules. So what I want to do now is I want to look at a case study of some retirees who, kind of a baseline scenario of their income where the husband dies before the wife, and she continues to receive the higher Social Security check. They have a joint life pension that she continues to receive. And now, because they're older, they have to take required distributions from their retirement account. But, and even though she doesn't need the income, we'll look at what are the impacts on her taxes and Medicare Part B premiums once they go from being married filing jointly to, becoming a single filer after her spouse's death. So let's jump over and take a look at that example. All right, so we're looking at the retirement plan for Spencer and Helen Winkler. They are 70 and 68 respectively. You can see here on the screen that their retirement savings, their overall, savings for retirement is $1.5 million, and their retirement paycheck, how much they are getting every single month from the various sources, is just over $10,000 per month net after taxes. So this money is coming from, they have Social Security benefits, they have a very small pension, and then they're taking money out of their retirement account to live on. So about $10,000 a month, they're comfortable, they're doing great. So let's look at their current tax situation. And then what I want to do is show you just how their taxes and the Medicare Part B premiums change once Spencer passes away. So I put here in the software, Spencer's going to pass away pretty early, just to really illustrate for you the impact that this can have for your Medicare expenses. So I'm going to go to this timeline, and you can see here in 2025, what we're looking at here is their gross annual income of $142. And you can see here they have Social Security benefits. Spencer is receiving his Social Security, Helen's receiving hers, and this is only showing partial years, so I'm going to jump forward to 2026. So Spencer waited until age 70 to claim his Social Security benefit, so he has a large benefit, and then Helen is receiving a smaller spousal benefit just based on half of Spencer's full retirement benefit. Remember, the spousal benefit, you don't get half of the age 70, you just get half of the full retirement age benefit. Okay, like I said, they have a small pension, and then they're taking some money out of their retirement accounts. Okay, so as we go along, you can see here below, what I want to illustrate is how their income changes over time, and then what happens with their taxes over time. So I'm going to zoom in on this, see if we can get a little bit of a better view of those taxes. Yeah, here we go. All right, so here in 2026, they have an income of $143,000 before taxes, and their expenses with everything, about $9,500 in expenses, and that's coming from ordinary income tax. They have some state income tax. They live in North Carolina, and go along and see how this changes over time. So we here can see their income. They're getting small cost of living adjustments, and as we go along, you see it's pretty straightforward. Now, what happens when Spencer passes away. So this is kind of interesting. In 2029, you can see their income is 174 gross, and then the next year Spencer passes away at age 75. You can see there's a small drop in their income. It's kind of fully reflected here in the following year, where really the only change in their income level is that they're no longer receiving the spousal benefit goes away. So you can see Helen now is receiving that full age 70 benefit from Spencer. This is what's known as a survivor Social Security benefit. So that's great. So this she's getting that. And then you can see here that for the portfolio distributions, we have $71,000 coming out. Now you might say, wow, her income, does she really need that $71,000 per year from the IRA? Well, this is part of the issue, is that because all their money is in pre-tax accounts, she's kind of forced to take that out from required minimum distribution. So even though she doesn't even need it per se to spend, she has to take it all out. And as you can see, what she ends up doing is socking away about $9,000 that she doesn't really need, and ends up just putting it into a savings account. But still, she had to pay taxes on that money when she took it out. Now, I'm going to come back down here and let's see how the taxes change as we go from one year to the next. So in the previous year, when Spencer's 74, you can see their total taxes are $17,900. We go along, he passes away. Now, all of a sudden, even though the income has dropped by about $20,000 per year, their taxes have almost doubled, from like $17,000 up to almost $30,000 per year. And you can see for the first time we see this IRMA, or this Medicare surtax, kicking in. So Helen's income has dropped. Now she's still fine, she's still comfortable, but her taxes have almost doubled and her Medicare has gone up. She has to pay an extra $3,000 a year just for her regular Medicare coverage. So we go along and you can see that remains in effect. Well, because of RMDs, she's forced to take out even more income. So we go along, you can see that her taxes just continue to go up, and she's forced to pay that extra $3,000 per year for her Medicare, even though she has the same plan perhaps as she had, before Spencer passed away. We keep going along, and now as she gets older and her IRA and investment balances continue to grow, but she's forced to take out money, now her Medicare costs continue to go up. So now she's paying an extra $6,000 per year for that same Medicare coverage. So let's look at, I want to go to another screen and I want to show kind of the lifetime impact of this versus doing some proactive planning. What we're looking at on the screen is a comparison between two strategies for this retired couple. So let's say that instead of just, spending out of their retirement accounts and doing, what I went over before, what if, while Spencer's still alive, this couple proactively did a few Roth conversions for, between age 70 and 75 before Spencer passes away, to shift money from his IRA account into a Roth IRA account? What impact would that have on the long-term taxes and Medicare Part B premium situation for Helen? So what's interesting here is that for the first couple of years of retirement, by simply doing Roth conversions up to the top of the second Medicare IRMA bracket, this would save them on average 9% in taxes over the life of their plan, which for them, that amounts to about $1.2 million of savings in taxes and extra Medicare Part B premiums. So really what we're looking at here is that they're going to proactively pay a little bit of extra taxes for the first couple years of retirement in order to save over $1 million over the life of their retirement. Now, granted, in this scenario, we're saying, okay, Spencer passes away after 5 years of retirement. Now, I'm guessing in your situation, you don't know when you're going to die or when your spouse is going to die. And then we're assuming here that Helen goes on and lives a long life. She lives to be about 90 years old. Do we know that's going to happen? No, we don't know it's going to happen. This is an element of retirement planning across the board, is that element of uncertainty. We make good guesses, we estimate, and we lay down plans based on good information and analysis. But obviously, there's never any guarantees that, these strategies, that things are going to work out. So what this is really doing is just to illustrate the impact that this would have given kind of this, set of information, this fact set. As you can see, it's definitely worth at least considering whether doing some proactive Roth conversions early in your retirement can make a a good long-term impact for your retirement plans, not only to save you on the tax rate that you pay, but also to create a more affordable situation for your healthcare costs for the rest of your retirement. So hopefully that's been helpful. So now that you understand the dramatic variations that can happen with Medicare costs, you can create a healthcare plan strategy that protects you and your retirement savings from these escalating expenses that can happen. If you are looking for more help with your retirement plan, click the link in the description to book a call where I'll analyze your specific situation and show you exactly how to build a healthcare strategy that accounts for these cost realities. And I'll see you in the next video.